A very good evening to all the participants of this webinar from DTRTI Lucknow. I am Arvind Mishra welcoming you to this webinar on subsidiary books, part 2. Today is 29th of October 2020 and we are studying sales return book and or the return inward book. As we have discussed earlier, the books which are called the subsidiary books are the purchase book, the sale book, the purchase return book, the sale return book, the bills receivable book, and the bills payable book. The books which are called the principal books are the cash book and the ledger. These principal books are used to make the trial balance and thereafter the financial statements. Of course, journals can also be subsidiary books because the entries in the journals also are used to prepare the ledger by posting the entries into the ledger. We have already discussed the purchase book and the sale book. And we had seen that the credit sale and the credit purchases are entered in those books, and those purchases or sales which are not credit sales or purchases, they will be entered in the cash book or they will be entered in the journal. Now, many times it happens that the customers will return the goods which are sold to them because of quality issues or any other issue. So it becomes convenient to record such returns in a separate book so that we know how much of our sold stock is being returned back. So therefore, all these sales returns are entered into a book called sales return book. It is also called the return inwards book. The columns in this book are similar to the purchase book or the sale book, and even the entries are also made in the same manner. As an illustration, we can see here the first column contains the date, the second column contains the particulars, and among the particulars are the name of the supplier or name of the customer, and thereafter the items which have been returned back and the amount for which they had been sold, less the trade discount. And whenever a sale return is made, the person who is returning back certain goods will issue a debit note to the person who had sold them. So we can write the debit note number also while making the entry out here in the return inwards book. So various items are separately mentioned, and then those items are totaled in the details column, and the trade discount is also reduced in the details column. Then there is a ledger folio column which shows how this entry is going into the ledger and on which page of the ledger it is being entered over here, over there. Now the next one is purchase return or the return outward book. This book records the return of goods or material which is purchased from any supplier and which is returned back to the supplier But of course, if these purchase returns are not frequent, it may be sufficient to record it in the journal. But if they are frequent returns, then it is always better to maintain a separate book called the purchase return book or the return outward book. And similarly for the sales return book also, if there are enough transactions, if there are not too few transactions, then it is better to have a separate book for that, so that we can keep track of the returns. The ruling of the or the columns of the purchase return or the return outward book are also similar to that of the purchase book, and even the entries are similar to the purchase book, as we have discussed earlier. So obviously there is a date column and there is a particulars column, and after the particulars column there is a detail column, and in the detail column the discount is also reduced, and every item is mentioned separately and maybe according to the bill, and the amount is also mentioned in the last column. Finally, all the amounts are totaled in the last column. Now the sales return book, it shows the total of how much of the sale which was made earlier has been returned back by the customers. Now really, the total of the returns is to be reduced from the sales. Therefore, while entering something in the sales, we are crediting the sales account. So in this case, to record the sale return, we can debit the sales account. But usually we don't do that. What we do is that we create a separate account called the return inward account or the sale return account, and the total of the sales returns will be debited to this account. Rather than debit it to the sales account, we debit it to the purchase return account. Now it should be noted that on goods being received, whenever the goods are being received and accepted from the customers, as a return of the sale, in that case a credit note is issued to the customer concerned. Credit note is a document by which we say that we have taken back this material from you, which is of this much value, and so we are crediting your account in our books. Now this shows the amount to be credited to the customer's account. That credit note shows that.
क्या होगा उसके पिक्चर का नाम चेंज करवा दी तो क्या होगा? बड़ी बात होगी। हाँ है। तोड़ दो रहा पैर में। ले बंद भी हो गया है। कैसे बंद हो गया?
Okay, so we move forward from here. So we were talking about the fact that whenever the goods which are sold earlier have been received back from the customers, any businessman will issue a credit note to the customer, and that credit note will carry the amount, the value of the credit which is going to be given to the customer against the return of the sold item. Similarly, whenever the goods are returned to the suppliers, the purchased goods are returned to the suppliers, then the suppliers will issue the credit note to the person who is returning back the goods. And the firm which is returning the goods will issue a debit note to the supplier. So if I were the purchaser and I am returning back certain material, I will issue a debit note to the supplier, and the supplier will issue a credit note to me, which will indicate the amount for which the supplier is liable on account of the return. Because when I return back something to my supplier, then he has to pay me for it. The total of the return outward book shows the total of the returns which were made out of the purchases. The amount can be credited to the purchase account. It is very rational to think that whenever we are returning back the purchase, we can credit the purchase account. But in practice, what is being done is a separate account is opened called the purchase return account or the return outward account, and that account will be credited. And the suppliers whose name appear in the books have received the goods because they have been returned back by us to them. So their accounts have to be debited. So we debit the supplier and we credit the purchase return account or the return outward account in case of a purchase return. We can see that in the illustration which is coming up, illustration 5. So we have been given a return outward book that we have purchased something and then we have returned it back. So this contains an entry that an amount of 200, which is a 136 inches Usha ceiling fan, is returned back, and the less trade discount is also reduced because this trade discount was given earlier. 200 minus 20 is 180, and apart from that, on 30th of November, Modern Electric Company, some item is returned back to that company also for 100 rupees. So what we have to do here is that in case of Rajendra Prakash and Sons, we are debiting Rajendra Prakash and Sons account and we are crediting the return outward account by rupees 180. We are debiting Modern Electric account by 100 and crediting return outward account by 100. We are also crediting return outward account as we are seeing out here for 100 plus 80, which is 280 rupees. Now, the small discussion on bills receivable books and bills payable books. You know, bills receivable are certain bills, or rather documents, which are a promise being given by the person who signs that bill, saying that on a certain date after a certain amount of time, he will pay the amount which is mentioned on that bill to the bearer of that bill. So normally, sometimes what happens is that we purchase something from somebody and we don't pay cash for it. We want to make it a credit payment. So what we do is that we just accept a bill payable. For us, it is a bill payable. And let's say that that bill payable is payable after 2 months. So we get about 2 months time to make the payment. So instead of paying cash, we just accept that bill. And the person who made the bill and presented it to us and we signed it, that person gets the bill and he can go to the bank and discount that bill and get the money minus some commission. So I was supposed to pay that amount. Instead of paying that amount, I just accepted the bill and that person got the money from the bank after a certain discount. That is the way the bill receivable and bills payable market works. After the end of 2 months, that bill is presented to me for payment and I make the payment. So I have got a credit period of 2 months. If such promissory notes or hundis are issued very frequently, then it is better to have a separate bills payable book where we can record these payments, or a bill receivable book where we can record the such receipts in form of the bills. If there are just 1 or 2 such payments, they can be always entered in the journal also we would not need a separate book unless and until we have frequent and more in number payments or receipts. So what do we get from all this discussion? Number one, if we were to understand what is the importance of a journal, we have already mentioned that all these purchase books, sale books, all the subsidiary books can be called a journal also, where entries are being made, and they are specialized books in nature. The cash transactions will be recorded in the cash book. Now, the credit purchases of the goods or the credit purchase of the materials or the factory, they are recorded in the purchase book. The credit sales are recorded in the sales book. Whatever returns we are getting from customers are recorded in the sales return book, and whatever returns are being made to the suppliers are entered in the purchase return book. Bill transactions are written or entered in the bills receivable book if there are too many transactions or the frequency is more, or in the bills payable book as the case may be, if the bills receivable book and the bills payable book is maintained. Apart from the transaction which is mentioned above, there are some entries also which have to be recorded. So there are some entries more which have to be recorded. For them, the proper place will be a journal. Some entries which could not be made in all these subsidiary books will properly be made in the journal. In fact, there is no special book which is meant to record a transaction. And any transaction is normally recorded in the journal. The role of the journal is thus restricted to, number one, opening entries. When the books are started for the new year, the opening balance of the assets and liabilities are written in the ledger. But before writing in the ledger, a journal entry is made. So opening entries are made with the help of the journal entry. The closing entry is also at the end of the year made with the help of the journal entry. Also, the rectification entry if an error is committed, it can be rectified sometimes through a journal entry. As far as closing entries are concerned, when the year ends, the profit and loss account has to be prepared. So for that purpose, all the nominal accounts are transferred to the profit and loss account. Now that is done through journal entries, which are called closing entries, by which these nominal accounts will be transferred to the profit and loss account. Then there are the transfer entries. So we can say that if some amount is to be transferred from one account to the another, then the transfer will be made through a journal entry. Now there is something called adjustment entries. At the end of the year, the amount of expenses or income may have to be adjusted for amounts which were received in advance or for amounts which are not yet, for which payment is not yet made. So on those two counts where payment is not yet made or some advance payment is adjusted against income, such an adjustment is made through the journal entries. Usually the entries will pertain to the outstanding expenses, that is expenses incurred but not yet paid for. These adjustment entries would be for outstanding expenses or for prepared expenses, or rather it should be called prepaid expenses, PREPAID. That is expenses which are paid in advance for some period in the future. So these adjustment entries could also be interest on capital, that is interest which is paid on proprietor's investment in the business, for which the business will pay interest to the proprietor. And then there will be a adjustment entry in the form of depreciation, fall in the value of assets, which are used on account of which are used in the business and this depreciation is normally entered into the books on account of water and account of tear. Sorry, on account of wear and tear. Because the assets, due to the use, they become less efficient, and their value therefore depreciates, and therefore by way of depreciation also some adjustment entries are made. And in order to enter these, in order to make adjustment on account of these outstanding expenses, like outstanding expenses will be expenses which have been incurred but not yet paid for. So they will have to be entered in the profit and loss account so that we can account for these expenses because they've been already incurred. Similarly, some expenses may be prepaid expenses in nature, that is, they are paid for but not to be accounted for because they are payments made for future expenses. So the future expenses need not be recorded in the present as an expenditure. Interest on capital is something which we record at the end of the year by making an adjustment entry. So all these adjustment entries are made through the journal entries. We are trying to understand what is the use of a journal, which is a very, very important thing to understand here. A journal is used to make opening entries, the closing entries, the rectification entries, the transfer entries. And the adjustment entries. And of course, there are some more reasons for making entry in the journal. Entries on dishonor of the bills. We've just discussed bills. If someone who accepted a promissory note is not able to pay on the due date which is mentioned on the promissory note or the bill, then the journal entry will be necessary to record this non-payment of the bill or the dishonor of the bill. Apart from that, there are some other miscellaneous entries also which may need to be journalized. We are trying to understand for what purpose the journal will be used when we have already understood that there are many transactions which are to be entered in the subsidiary books. So journal also being a subsidiary book, how it is going to be used and in what conditions will a journal entry would be made, that is what we are trying to understand. So there are some miscellaneous entries which need to be journalized, which need to be entered in the journal. Number one, if you are making any credit purchase of such items which are not the normal goods which are dealt with or dealt in by that business, which are not the materials which are dealt in or dealt with by the business, and a credit purchase of such items is being made, in that case, they can be entered in the journal straight away rather than entering it in the purchase book. Because in the purchase book, though we are entering the credit purchases, but we are entering the credit purchases only of the goods which are dealt in by that business, or the credit purchases of the materials which are required for production of the goods for the factory, in the factory. So examples could be like credit purchase of furniture or machinery, because furniture or machinery is not something, is not a good, is not a material which is either required for the production of the goods in the factory, or it is not even goods which are dealt in by that business. The second entry which is required to be done in the journal, it is an allowance which is given to the customer or a charge which is to be made to them after the issue of the invoice. Invoice has already been issued. The sale invoice has been issued, but after the issue of the invoice, there is a certain allowance to be given to the customer, or either there is an allowance to be given to the customer or some payment which is to be taken from the customer. So whenever such allowance or such payment is taken or some charge is made upon the customer, then it will be entered straight in the journal rather than in any other book. Because if there was a sale earlier, that was entered in the sale book in case that was a credit sale. But here, what is happening is that out of that sale value, there is some allowance being given to the customer, which could be a renegotiated deal, or maybe either an allowance or maybe a further charge is being made upon the customer. That is, he has to pay even more. So then, in these two cases where he has to pay even more than what was promised earlier that to the customer, or if there is a reduction or charge to be made or an allowance to the customer, or maybe a further discount. So that will also be entered in the journal. Now, if separate bill books have not been maintained, then receipt of promissory notes or issue of promissory notes can be entered in the journal also. If there are too frequent promissory notes being issued, then we can have separate bill books for it. But if they are not few in number, then separate bill books are always if they are not maintained, if separate bill books have not been maintained, then the entry would be made in the journal, not otherwise. And normally separate books will be maintained when the transactions by bills are frequent. Now, another reason by which or when an entry is made in the journal rather than any other subsidiary book, when an amount becomes irrecoverable, it is no longer recoverable because the customer maybe he has become insolvent. In that case, also this can be entered in the journal, or it must be entered in the journal. An accident may happen due to which the property may be lost by a fire. So this loss can also be entered straight in the journal. And then in order to transfer the net profit to the capital account, we make a journal entry for that purpose also. So all these 6 types of entries are miscellaneous entries which are entered in the journal, which are journalized and then transferred to the ledger, posted to the ledger rather. Now let us take some example. We are being given some details, and on the basis of these details we have to prepare the purchase returns book of Alpha and Company, the company who is a sari dealer. And then first we have to prepare the purchase return book, and then we have to post the entries into the ledger. So first of all, on 4th of 2016, a debit note has been issued because goods have been returned to Goel Mills. Goel Mills was a supplier to whom the goods have been returned, and on 9th of August there is Gurg Mills quota has accepted the return of the goods which were purchased for cash from us. So we had sold something to Gurg Mills, and or rather we have purchased something from Gurg Mills and we returned those goods to Gurg Mills, and Gurg Mills has accepted the return of the goods on 9th of January. Then the 16th of January, a goods return is being made to Bethel Mills, and when a goods return is being made, a debit note is being issued. As you can see, 5 silk saris at 2,600 per piece. And on 30th, the return of one computer, which is a defective computer, at the rate of 35,000 to B and company. So, as we are seeing here, we are writing the purchase return book, and so we can see here the purchase which was made earlier have been returned back. So the purchase which was returned to Goel Mills was entered once, and then this Garg Mills also accepted the return of the goods. It should be, I think, Goel Mills, because the goods were returned to Goel Mills and 5 polyester saris were there. But what is mentioned in the second part is 9th January. Garg Mills has accepted the return of goods which are purchased for cash. Now, since this return back is of the goods which are purchased from cash, not credit, therefore this 9th January transaction will not be entered in the purchase return book, because purchase return book will only carry those transactions which are credit transactions and not cash transactions. So this, because this 9th January transaction is a cash transaction, that would not be entered into the purchase return book. So if we were to take a summary of all this, instead of recording all the journal entries in one register only, like in the journal only, it is some of the transactions are categorized and the entries are made on the basis of those types of transactions. So sometimes what we do is that we make certain entries like purchase entry or a sale, credit purchase or credit sale entry in the purchase book or the sale book, and when the purchase return is there, we enter the same thing into the purchase book or the sale book, or whenever the sales return also. So that helps us in categorizing the purchases separately or sales separately, or purchase return or sales return separately. And by categorization, we are helped to understand how much of our goods are of certain quality which are not acceptable in the market. So categorization always helps to understand how much is the purchase return in comparison to total purchases, how much is the sales return in comparison to total sales. So when these transactions of purchase, sale, credit purchase and credit sale, or purchase return and sales return become frequent, then we resort to entering them into the register. Similarly for the bills receivable and bills payable. Now, so many subsidiary books are maintained so as to record the transactions of one particular type in separate register. And therefore, these subsidiary books are also called the books of original entry or the books of the prime entry. Examples of subsidiary books are we have already seen, but they are purchase book, sale book, purchase return book, sales return book, bills receivable book, etc. And of course, the journal also. On the basis of these subsidiary books, the ledger accounts will be prepared. On the basis of the principal books, the trial balance and the principal accounts are prepared, or the financial statements are prepared. But on the basis of the subsidiary books, the ledger accounts are prepared. So we can say in form of multiple choice questions that in purchase book, the record is in respect of the credit purchase of the goods dealt in by that concern. Similarly, sales return book will record the return of the goods which were sold, return of goods sold. The sales book is a part of the journal. Yes, that's right. It's part of the journal. The entry is made from here to the ledger. The weekly or monthly total of the purchase book, the weekly total or the monthly total, is posted to the debit of the purchase account. The total of the sales book is posted to the credit of the sales account. Now, which is that book of original entry where we can record an allowance of rupees 50, which was offered for an early payment of cash of 1,550. So this is a book where cash payment is being made and an allowance is given of 50 rupees for cash payment. There is no credit allowed here. It is a matter of cash. So obviously this will be entered in the cash book. It's not required to be entered either in the journal or in the sales book, because an allowance is being made of 50 rupees with an early payment of cash has to be made. Now, second-hand motor car was purchased on credit from B brothers for 10,000 rupees will be recorded where it is a motor car, and therefore it will not be entered into the sales book because the SSC is not dealing in motor cars as such. It will be not entered in the cash book because it is a credit purchase, and therefore it will not be even entered in the purchase book because it is not a goods in which the company is dealing. So obviously, a second-hand motor car can only be the purchase of the second-hand motor car on credit for 10,000 rupees can only be entered in the journal, which we can call a journal proper or a general journal. So difficult to pronounce two words, general journal. And as the last question, which is that book of original entry will be where we can record the bills receivable of 1,000, which was received from a debtor in full settlement for a claim of 1,100, is dishonored. So here what is happening is that a bill which was receivable is dishonored, therefore, and we have to write this in a book of original entry. This is one bill which was receivable of 1,000 rupees, bill receivable of 1,000 rupees, which was received from a debtor in full settlement. And this one single bill is being received, and therefore we don't need an entire bill receivable book for a single bill receivable. What all we can do is here is put it in the journal. So with that, we have come to the end of subsidiary books part 2. Please try out the practical questions and the theoretical questions, and of course the MCQs also. We have also prepared MCQs for this topic and we'll be delivering them to you. So kindly, it's a request that please prepare your bookkeeping and accountancy subject properly so that you can attempt the questions also and successfully. And a preparation will be said to be complete when you have gone through it and you have revised it. For anything to get inside the brain properly, you have to revise it once on the day on which you prepare, on the day on which you read it, then after 7 days, and once more after 30 days. So these 7 days and 30 days part, we propose to cover by forcing you to make a revision of that topic for our mock tests. So with those words, thank you very much for having attended this session, and do attend our morning session tomorrow also.